Hi, welcome back. Every year when I update my data, I do a few posts on what I've learned by looking at the data. This year, I thought I would look at not just 2019, the year for which I collected the data, but an entire decade. Because it's been a testing period for lots of investors, especially value investors, who found that things they've always believed in, things they thought worked in markets, did not seem to work in the last decade. It was also a decade where trust in mean reversion was shaken. What's mean reversion? Assuming things revert back to the way they used to be. Whether it was interest rates or PE ratios, things did not seem to revert to historic norms. So let's start by listing out what stocks did in 2019 and at the whole decade. Looking just at 2019, it was a very good year for stocks. Stocks were up about 31% if you include dividends in those returns. It was not the very best year for stocks. It was the 16th best year out of the last 92, but 31.22% with about 2% from dividends and 29% from price appreciation is not bad. In fact, as I said, it's the 16th best year of the last 92 years, but bonds were not slackers either. In 2019, the 10-year U.S. Treasury bond returned about 9.64%, and 10-year BAA corporate bonds, this is investment-grade corporate bonds, weighed in at about 15.33% return. Now you're saying, where did those returns come from? The coupons were so low. You're right. The bulk of those returns in these cases did not come from the coupons, they came from price appreciation. Why did the price appreciate? Well, because interest rates dropped. The T-bond rate went from 2.69% down to 1.92%. That accounted for a big chunk of that 9.64%. And corporate bonds got an added oomph, which is the default spread over the Treasury bond also decreased. So in addition to the T-bond rate falling, the default spread dropped. So it was a good year for stocks and a good year for bonds. Now let's look at how the decade measures up. Looking first at stock returns, you can see that the decade was a pretty good one, 253% over the entire decade. But if you look at it in perspective, by looking at decades going back to the 1930s, it falls somewhere in the middle, right? It wasn't as good as the 1980 through 89 or the 1990 through 99 decade. Back-to-back decades where you saw astronomical returns on stocks, but it was much better than the 60 to 69 or 7, and definitely bounced back from the 2000 to 2009 abysmal decade. The lost decade, where the 2008 crisis actually created a decade where stocks dropped over the entire decade. Now, if you look at bond returns, they fall somewhere in the middle. Now, if you look at the T-bond, you made about 50% over the 10 years. Not bad if you include the coupons, the price appreciation. It's not as bad as it was in the 50s, but clearly not as good as it was again in the 80s and the 90s. So it was a good decade for stocks and a middling decade for bonds and corporate bonds. If you look at T-bills, though, the 5.25% was in fact the lowest return we've had since the 1940s. It was not a good decade to be in cash. Now, let's take that historical data over the decade and over the longer period. Let's see what we can extract from this. The first is we can look at historical equity risk premiums. What's an equity risk premium? It's the price of risk in the equity market. And most people, when they think about the price of risk in the equity market, look backwards. Why? Because that's where the data is. In fact, this is a number that gets used in valuation, and it's a big issue in asset allocation and whether you invest in stocks in the first place. So if you look backwards and look at what stocks have earned relative to T-bonds and T-bills, now that we've brought in the 2019 data point in, here's what the historical data looks like. Stocks have earned about 4.83% more than T-bonds if you look at geometric averages, if you go back all the way to 1928. If you go to 1970, they've earned about 3.5% over T-bonds, less. And if you go back just to 2010, the premium has been close to 9.31%. You're saying, which one should I use? Well, here's a dead giveaway. See those red numbers? Those are the standard errors in the historical estimates. Even if I go back all the way to 1928, that's 92 years of data, the standard error is about 2.2%. So even though it looks like a long time period, the estimates you get looking backwards are noisy. There's a second problem. Even if you decide to go with these historical premiums, Remember, they're backward looking. We're assuming that things will revert back to the way they used to be. Let's say you're okay with that. If you buy into using historical premiums and you decide to go back all the way to 1928, because remember, if you go back 10 or 20 or 30 years, it's pure noise. Here's what returns will look like in 2020. Notice, I'm not a market timer. I'm not predicting where the market will go, but given history, here's what we can expect. So let's take that 4.83% historical premium for stocks over T-bonds. You're saying, why are you looking at geometric averages? Because returns compound on stocks, especially if you're looking at long time horizons. If you take the T-bond rate at the start of 2020, which was 1.92%, you add the 4.83% historical risk premium, you come up with 6.75%. You're saying, what is that? That's my expected return on stocks in 2020. Am I saying the S&P 500 will increase by 6.75% in 2020? Not quite, and here's why. A portion of that return is going to come from dividends. That portion is a fairly small number now. It's about 1.82% at the start of 2020. That's a dividend yield. You subtract that from the 6.75%, you get an expected price appreciation of 4.93%. You want to play market guru? Here's what you can do. Take the level of the index at the start of 2020, attach a 4.93% price appreciation to it. You'll have the expected S&P 500 at the end of the year if you trust historical risk premiums. Second, if you look at this data, and you've been told this, I'm sure, and you've read this in multiple places, that stocks always win in the long term. I've never understood that statement. If stocks always win in the long term, shouldn't the equity risk premium in the long term converge on zero? Because you're guaranteed a premium. Stocks don't always win in the long term. In fact, if you look across the decades, and I'm going to go back to the table in the decades, you will notice there have been decades where stocks have underperformed, both T-bills and T-bonds. Take 2000 through 2009. Stocks underperformed. 1970 through 79. So the notion that stocks always beat treasuries is misplaced, because there will be decades where that's not true. You're saying a decade is not a long enough time period? You might want to check the actuarial tables. Decade is a really long time period. You're saying, what if my time horizon runs into multiple decades? Even then, nothing is guaranteed. You're saying, but the history here seems to suggest that stocks have beaten bonds and T-bills. You're right, if you look at U.S. markets. But remember, the U.S. equity market in the 20th century was one of the most successful equity markets globally. Using that to draw conclusions about equities overall has a selection bias problem. What if you invest in the Austrian market? Or let's say if you wanted to go with something more recent, you invest in the Nikkei at the height of its glory in 87. You wouldn't have made your money back for 30 years. So the notion that stocks always win is a dangerous one. I'm not trying to talk you out of investing in stocks, but you have to recognize that even with a long time horizon, if you get into stocks at the wrong time and in the wrong market, you might not make your money back, and that's why we demand an equity risk premium. Third, looking at that data across the decades, you can see both the pluses and minuses of market timing. Again, let me go back to the decade-based data. If you are a good market timer and you could have stayed out of stocks between 2000 and 2009, you'd have saved yourself a lot of money, right? So if you're a good market timer and you can stay out of the bad years, you can say, this is good, I can make a lot more money, and you're absolutely right. But here's the problem. No market timing mechanism that I know of is perfect. Market timing mechanisms are going to keep you, even if they're good mechanisms, they're going to keep you out of stocks in bad years, but they're also going to keep you out of stocks in good years. And the cost of market timing is if you're out of stocks in a good year, or worse, in a good decade, think of how much money you leave on the table. In fact, in the last decade, between 2010 and 2019, I know lots of very smart investors who are market timers who chose to stay out of stocks and bonds because they thought interest rates were artificially low. They had a basis for that, right? And we'll talk a little bit more about this. But T-bond rates were much lower than historic norms, and these market timers stayed out of stocks. Think of how much money you'd have left on the table because of that. So I'm not trying to talk you out of market timing. That's not my job. But if you're a market timer, think of the trade-off here. You will avoid some bad years, but you will also be out of stocks in good years. And unless you're a good enough market timer for the former to outweigh the latter, you're going to lose money over time. Timing markets. The second big factor that you see looking across the last decade was it was a low interest rate decade. And you can see this by looking first at the graph, where I've graphed out 10-year T-bond rates and T-bill rates going back to 1928. And I've also looked at the average T-bill rate and T-bond rate every decade, again going back to the 30s. Between 2010 and 2019, the average T-bill rate over the 10 years was 0.52%. The average T-bond rate was 2.5%. There hasn't been a decade with interest rates this low since the 1940s. Clearly, this was a decade of low interest rates. Now you're saying, well, that's obvious. It was because central banks were doing all kinds of crazy things. And in fact, there are many people who assume that interest rates were low in the last decade simply because central banks willed them to be low. With what? Quantitative easing, with monetary policy. I'm not going to, again, talk you out of that notion, because central banks clearly had a role to play in keeping rates low, because especially after the 2008 crisis, they became much more active in trying to keep rates low. But I don't think you can blame this on central banks alone. In fact, one of my favorite devices to explain interest rates is to compute what's called an intrinsic risk-free rate. You're saying, what is an intrinsic risk-free rate? It's obtained by adding up the expected inflation, or actually the actual inflation rate, to the real GDP growth rate. Basically, I'm saying in the long term, interest rates should be a sum of expected inflation and expected real interest rates, and real interest rates should converge on real growth. So what you see in this graph is first the T-bond rate every year. The T-bond rate is the red line that you see on the graph. The black line is the intrinsic risk-free rate each is just the combination of inflation and real GDP, which are the bars you see. The black line is a smoothed out intrinsic risk-free rate. What is smoothed out? Because inflation and GDP tend to jump around. It took a 10-year average. Notice how well the intrinsic risk-free rate explains why T-bond rates have been low. T-bond rates, interest rates have been low in the U.S. because inflation has been low and real growth has been anemic. And I could say the same thing in spades for why the euro risk-free rate is not just low but negative. So when you look at risk-free rates, it is clear they're lower than they've been historically, but there's a reason they're lower. Incidentally, the gap between the intrinsic risk-free rate and the actual risk-free rate was widest in at the end of 2019 as it has been for the entire decade, which might be an indicator that interest rates are going up this year. I'm not going to suggest again you go out and do anything crazy, but that gap widening suggests that there is an increase in interest rates on the horizon. So that was the second factor. Third, looking across stocks, not all stocks benefited from this decade. In fact, if you look at the different sectors that make up the S&P, this was a decade that saw shifts. First, and one of the biggest shifts, energy stocks, the energy as a sector dropped from almost 12% of the index at the end of 2009 to less than 5% by the end of 2019. It was a bad decade for energy stocks. Well, part of the reason for that was a drop in oil prices in the earlier part of the decade. But there's more going on. Looking forward, people feel a lot more pessimistic about oil companies and fossil fuel companies than they used to, and you see that reflect in the pricing. The second big shift was the rise of technology. Now, if you look at the slice that makes up technology, the lowest slice, it doesn't look like it's changed much. It went from 19 to 22%. You're saying big deal. That's not a big move. That's only because Google and Facebook, which used to be part of the technology sector at the start of the decade, were moved out of it into the communication services sector in 2018. If they'd been left in, technology would be about 30% of the index. Technology stocks clearly became a much bigger part of the index, but but the definition and the fact that Google and Facebook got moved to communication services, in my view, was a good thing, because technology has become too broad an area because it includes stocks like Google and Facebook that are really online advertising companies. It includes companies like like Microsoft, which are software companies, includes hardware companies. It's including a very diverse set of companies, but clearly technology was the wild card. But wasn't all of technology either, right? There were some big winners. In fact, we know that there were 5 big winners: Facebook, Amazon, Apple, Netflix, and Google. The FAANG stocks were the big winners over the decade. How much of the winners in this graph, I've actually traced out how much value added came from just these 5 stocks and compared it to the market cap increase in the S&P 500. Over the decade, these 5 companies alone accounted for $3.4 trillion in increased market cap. $3.4 trillion. That was 22% of the increase in market cap of the S&P 500 over the decade. It's not quite a fair comparison because Facebook didn't even go public to 2012, and not all of these 5 stocks were part of the S&P 500. But the reality is, if you did not own any of these 5 stocks over the entire decade, your task of beating the market got a lot more difficult. Fourth big factor that you see as you look at the last decade is some old patterns got breaking. So we've been told so things that we took for granted in finance, that we assumed were facts, started to get shaken. For instance, I know if you've taken a finance class or you're a believer in investing, you've heard that value stocks beat growth stocks, and it's backed up by data. You've also been told that there's a small cap premium, that investing in small cap stocks, you will earn a premium over and above what you'd earn by investing in large cap stocks or average cap stocks. Well, in the last decade, both those results came to be challenged. Let's start with value versus growth. Let's start with the good news if you're a value investor. If I go all the way back to 1927 and graph out what I'd have made investing in low price to book stocks, I know it's a very sloppy way of defining value, but that's how many of these value studies in the past have been done, and compared them to high price to book stocks, on average over this entire time period, the lowest price to book value stocks, the lowest decile, have earned about a little bit more than 5%, 5.21% than the highest price to book value stocks. Over this entire time period, you can see why people look at this graph and say, hey, value beats growth. Well, if you break things down by decade, things get a little more shaky. Here I've compared the returns you'd have made on the lowest price to book value decile versus the highest price to book value decile by decade. And I've also brought in lowest PE and highest PE, another rough proxy for value versus growth. But that data starts only in the 1950s. As you can see here, things started to shift in the 1980s. Now, prior to the 1980s, you could see that value stocks beat growth stocks pretty much every decade. 1980s, that persisted, but then in the 1990s, you saw a reversal. Then the last decade, 2000 to 2009, you saw it bounce back, and then 2010, 2019, the value effect seems to have completely dissipated. Now, when you look at this graph, you're a value investor, your first reaction, it's an aberration. 2010 through 2019 was just a bad decade. Maybe it was central banks, maybe it was low interest rates. You might be looking for excuses. In fact, if you look at the entire time period from 1980 through 2019, the value growth effect has become a lot hazier. Maybe there's been a structural shift. I'm not suggesting it's happened yet, but maybe we should look askance at this notion that we take for granted that value stocks always beat growth stocks. Now, what about the size premium? Again, I can start with the good news. If I go all the way back to 1927 and graph out what the smallest cap stocks have done versus the largest cap stocks, and here you see the breakdown by decile. The smallest stocks, the lowest decile, stocks in the lowest decile in terms of market cap, have delivered substantially higher returns than stocks in the highest decile. Well, that's true if you use value weighted, where the portfolio is created based on the values of the companies. It gets even stronger when you use equally weighted, which means that the small cap premium is coming from the really small stocks in the market. So you look at this graph, you can see the basis for the small cap premium. How is this played out? In investing, this has led people to invest in small cap stocks expecting to earn a premium. In valuation, it's led to the use of what's called a small cap premium in adjusting discount rates. When you value a small company, this is what you're taught to do. Take the risk-free rate plus some measure of risk, beta times risk premium, plus a small cap premium. And that number can range from 4 to 5%, especially if you go back to 1927. Here again, if you break things down by decade, things get a little messier. Again, if you look at pre-1980 and post-1980, you can see the shift occurring. Pre-1980, it looks like there's a significant and a very strong small cap premium. Post-1980, that premium gets shakier. In fact, between 2010 and 2019, there was no evidence that small cap stocks earned a larger premium. In fact, if you look at equally weighted portfolios, the smallest companies did much worse than the largest companies in the last decade. Again, you could dismiss the decade, but I would suggest that maybe it's time to go back and examine that notion that small cap stocks earn a premium over large cap stocks. Maybe again, there's been a structural shift in markets that explains this. Finally, let's talk about the buzzwords. Every decade brings its own buzzwords, and for me, there were a few buzzwords that showed up in the last decade. I'm not dismissing these words, but the two big trends that I saw was, one was this glorification of what we call big data. The fact that we can collect and analyze incredible amounts of data and how it creates value for companies. The second is the notion of crowd wisdom. Something we in finance have dealt with for hundreds of years because markets are the ultimate crowd wisdom, but other disciplines seem to discover the magic of crowd wisdom, where we started to get out, rather than go with experts, we went with crowds. So let's take a closer look at both of these phenomena. Let's start with the big data phenomenon. I think part of the reason for the glorification of big data is if you look at the FAANG stocks. One factor that they all share in common is they have millions of users, sometimes tens of millions of users that they collect data on, and they seem to use this data to create more benefits for themselves, make themselves stronger. Networking benefits, where as you get larger, it gets easier to get larger. But I would caution you on big data. While the Netflix and the Googles and the Facebooks and the Amazons and even the Apples have learned ways to use that big data, I think big data has been oversold as a concept, because for big data to have value, I believe two things have to be true. The first is the data you collect has to be exclusive. In other words, you and only you have that data. If everybody has it, nobody has it. What do I mean? Well, let's suppose you've created a business. We can track my location. You think you're special? This morning when I checked on my iPhone, there were 27 apps that were tracking me. Everybody knows where I am at any point in time. So the data is not exclusive. So having location data, who cares? Netflix and Amazon, you can see already, have exclusive data. Netflix, because it knows what you watch, what you stop watching, it knows your viewing habits. And Amazon, because they know pretty much everything about you, not just where you shop, but if you have Alexa in your house, God only knows what they've collected as information about you. The second, the data has to be useful to you, and it's got to be actionable. You got to be able to use the data to either create new products and services or adapt existing ones. Again, Netflix and Amazon are good examples of how data can be used. Netflix uses the data it collects from viewers not only to show you new shows you might like, but also to create new content. Amazon uses the data it's collected on you to kind of fine-tune how you shop, what you see, and go further in terms of determining where you might be going next and determining trends in shopping. For big data to be valuable, it's got to be exclusive and actionable. In my view, 95% of companies that are paying big money for big data and hiring people to analyze the data will never see a payoff from that data. The other big word was crowd wisdom. And I think I can trace this back to the 2008 crisis, because one of the consequences of that crisis is we lost faith. We lost faith in experts and institutions because we saw the damage that was created in 2008 and how little they were able to do to stop that. It's no coincidence that Satoshi Nakamoto, not a real person, we know, a pseudonym, we have no idea who it is, posted a paper laying out the architecture for Bitcoin in November of 2008. If you cut past all of the hype around Bitcoin, its core concept was it had no central bank, no regulatory overlay, and that transactions would be crowd checked by miners on computers. But the essence of Bitcoin was you could not trust institutions and experts. Now you're wondering why I haven't spent more time talking about Bitcoin as one of the things that happened in the last decade. In my view, Bitcoin was much hype, but it really left a very small imprint, because you look at its collective value, it didn't create much in value, didn't change the way we did transactions. It was more successful as a speculative device than as a currency. But what came out of Bitcoin, which is blockchain, is essentially a mechanism that essentially replaces institutions with crowd checking. And I think in a sense that's it's gone beyond Bitcoin and cryptos into the rest of our choices. Think of how we pick restaurants. We no longer look at restaurant reviews, we look at Yelp reviews. Think of how we decide what movies to watch. We look at Rotten Tomatoes. We don't look at, what did the New York Times movie critic think about the movie. I think increasingly people are trusting crowds to make judgments for them, and I don't have a problem with that. I know I share the distrust of experts that so many others have, but I would caution you on the wisdom of crowds. Crowds are incredibly effective sometimes at coming up with right answers. That's why we have financial markets. That's why we trust market prices. But as we found in financial markets, crowds can be wise, but crowds can also go mad. In fact, one of my favorite books is The Madness of Crowds. It explains how sometimes crowds can have a herd mentality and make bad choices. So again, while I see the trend towards crowd wisdom, and I would be cautious about putting too much weight on what the crowd thinks, because crowds can sometimes be wrong. So what about the decade to come? Well, I have no idea what we've learned from the past. It's going to go. I know we can draw on sayings here. I mean, I know it's been said that those who those who forget the past are destined to relive it. That's why we look at history. But we've also been told that generals who prepare too much to fight the last war never win the next one. I think there's a danger in reading too much into what's happened in the last decade, and there's a danger in not ignoring it completely. So here's what I think about the decade to come. It's going to look nothing like the last one. But if there's nothing else I've learned in the last 10 years, over the last decade, it's to keep an open mind, to question conventional wisdom, to not take things for given. And if I can stay adaptable and I keep learning, maybe I'll be able to deal with the next decade. And we'll see whether, if God willing, 10 years from now, when I do my blog post on the last decade, let's see how different it was relative to 2010 through 2019. Thank you so much for listening.